Good morning to one and all present here. I am Dr. Sridharan, Department of Corporate Secretaryship, Guru Nanak College, Autonomous, Chennai. Now, I am going to present about the basics of income tax. Okay, these are the points to be discussed now. Introduction, brief history of income tax, some important terms, heads of income and income tax rates, exemption, deductions, some useful tips, conclusions. What is income tax? First, you must know answer for this question. Okay, it's a $1 million question. Tax is a part of individual earnings which is required to be paid to the government in order to generate revenues. It is a mandatory liability for every citizen of the country. The tax levied by the government is a multi-dimensional instrument. It helps the resource mobilization. It helps the government to take up the schemes and projects for economic development and solve the basic problems of poor and underprivileged. There are two types of tax in India, direct tax and indirect tax. Income tax is a part of direct tax. The types of taxes, direct tax and indirect tax, income tax, wealth tax, gift tax, this comes under the direct tax. In the year 1997, gift tax is abolished, and indirect tax, the GST introduced in 1st July 2017. There are 4 types of GST, is that CGST, SGST, IGST and UGST. Now, let us discuss about the brief history of income tax. Origin of taxation dates back to ancient India as found mentioned in ancient books such as Astasastra, Manusmriti. And modern India, tax introduced for the first time in 1860 for Sir James Wilson in order to meet the laws sustained on account of military mutiny of 1857. This was the first time income tax of modern India. The government is consulted with the Ministry of Law and finally passed the Income Tax Act 1961. Let us discuss about canon of taxation. Adam Smith has propounded 4 canon of taxation: general rules, rules of taxation, canon of equality, canon of certainty, canon of convenience, canon of economy. Let us understand about the degree of progression of tax. It is classified into 4 types: proportional tax, progressive tax, regressive tax and digressive tax. Now, the proportional tax, this tax rate is constant. If the income is more or less, irrespective of whether the income tax payers income is high or low, the tax rate is constant. And the progressive tax, if the income is increases, the tax rate also simultaneously increases from 10%, 15%, 20, 25, 30. If income is increased 5 lakh to 10 lakh, 10 lakh to 15 lakh, simultaneously the tax rate is also increases. Then regressive taxation is quite opposite to that. If the income is increases, tax rate will decrease. Then digressive taxation, income is increases, tax rates also increase up to certain point. Thereafterwards, that uniform tax rate will be charged. For example, income of up to 2,50,000 is nil, 2,50,000 to 5 lakh 5%, 5 lakh to 10 lakh 20%, above 10 lakh whatever the income may be, the flat rate 30%. Then additional tax liability is there, cess is there, secondary education, higher education and health 4%. Apart from that, there is additional tax liability is there, surcharge, tax on tax. If the income is exceed 50 lakhs, up to 50 lakhs, no tax. If income is exceed 50 lakh, surcharge will be levied. Then important terms to be discussed now: assessment, assessee, assessment year, previous year, person, residential status, income, gross total income, deductions. Assessment. Assessment is the procedure by which income of an assessee is determined by the assessing office. Assessee. There are 3 types of assessees there: normal assessee, deemed assessee, assessee in default. Assessee means a person whom any tax or any sum of money is payable under the Act. Then assessment year, section 2, subsection 9. Taxpayers' income of the previous year is assessed to tax in the assessment year at the rate prescribed for the Finance Act. It consists of 12 months. The period of commence from 1st April to 31st March. The next previous year, section 3. Income earned in the year taxable in the next year. Okay. The current year, whatever you earn income will be taxed in the next year. In which year the income is earned, that is called as previous year. In which year the income is to be assessed, that is known as assessment year. Current previous year 2020-21. Current assessment year 2021-22. Person under section 2 subsection 31 defines that individuals, HUEF, company, firm, association of person, body of individuals, local authority, artificial judicial person. These are the categories comes under the term definition person. Income under section 2 subsection 24. Income denotes that a percentage of monetary return coming with the some sort of regularity or expected regularity from the definite sources. Gross total income, it comprises of 5 heads of income. Deductions, there are several deductions is the gross total income deduction, section 80C to 80U. Okay. This is for only for saving purpose. Then total income, gross total income minus deductions, standard deductions from gross total income. There are 80 section 80C to 80U. Residential status. Residential status of an assessee is an important to determining the scope of income on which income tax is to be paid in India. There are three different types of residential status: resident and ordinary resident, resident but not ordinary resident, non-resident. Okay. There are two types of conditions: there two basic condition, two additional condition. The assessee who satisfy two basic condition, one additional condition is become resident and ordinary resident. The assessee will satisfy one basic condition, none of the additional condition is become resident but not ordinary resident. The assessee who does not satisfy the basic condition itself is become non-resident. Now let us enlighten about that heads of income. Income from salary, income from house property, income from business or profession, income from capital gain, income from other sources. Income from salary includes basic salary, DA, bonus, commission, allowances, that is monetary benefit, perquisites, non-monetary benefits, retirement benefit, gratuity, pension, all those things. All to put together, it is called as gross salary. Then there are certain deductions, is there? Three deductions. Deduction under standard deduction under section 16(1), 50,000 rupees maximum ceiling. And retirement allowances deduction under section 16 subsection 2, it is available only for government employees. Professional tax paid by the employer. There are three deductions, is there? Taxable income from salary. Then allowances. The allowances is there are three types of allowances, is there? Fully taxable allowance, partly taxable allowance, partly exempted allowance, and fully exempted allowance. Now we are going to discuss about partly taxable and partly exempted allowance. For example, HRA. Actual HRA received, rent paid minus 10% of salary, 50% of salary in case of metropolitan cities. Then other cities 40% of salary, whichever is least is can claim exemption. Likewise, entertainment allowances. Okay. Actual entertainment allowances received, notified limit 5,000 rupees, 20% of basic salary. Which one is least is can claim as accepted entertainment allowances. Next, retirement benefit. Gratuity under section 10 subsection 10, death cum retirement of gratuity. Government employee fully exempted. Then employee covered under the Payment of Gratuity Act 1972. Actual amount of gratuity received are rupees 20 lakhs and 15 days of average salary for loss drawn for every completed years of services. A part of services is more than 6 months to be converted into one completed years. Then other employees, actual amount of gratuity received, notified limit 20 lakhs and half of the average salary for the last 10 months drawn for every completed years of service only to be taken into account. The retirement benefit, pension, uncommuted pensions, monthly pension, it is fully taxable in the case of government as well as non-government employees. Then commuted pension, lump sum amount, computed pension is fully exempted for government employees. Non-government employees, 1/3 of pension is exempted if the employee receives gratuity. Half of the pension is exempted if the employee does not receive gratuity. The next, income from house property. There are three types of house is there. One is let out house, deemed to be let out house, self-occupied house. Now the current assessment here that you can claim two self-occupied house as a exempted house. Okay, we no need to pay tax for the two self-occupied house. Then let out house and deemed to be let out house, you have to pay tax for that. You have to find out first, you have to arrive gross annual value less local tax or municipal tax, then you can arrive net annual value. There are deductions is there, standard deduction of 30% of NAV, interest and loan. There are two deductions available and the taxable income. The next, income from business or profession. Now we can see about the income from business. Net profit, profit and loss account, less income from other heads. Add income, inadmissible expenses, debit balance to P&L account, inadmissible expenses not claimed. Add taxable business income not recorded. Then taxable business income. Income from profession, professional receipt minus professional payment. For example, medical practitioners and legal practitioners and professional practitioners, they can come under these professional categories. Then income from capital gain. Then capital assets are classified into two broad categories. One is long-term capital assets, other one is short-term capital assets. Long-term capital asset is the listed securities more than 12 months, unlisted securities more than 24 months, any other assets more than 36 months. So all comes under long-term capital assets. Then quite opposite to that, short-term capital assets. If the listed securities less than 12 months, unlisted securities not more than 24 months, any other assets not more than 36 months, that falls in this category. Okay. Then calculation of capital gain, net sale consideration, we have to find out sale consideration minus selling expenses, then less cost of acquisition, cost of improvement. There are certain deductions available under section 54, 54B, 54D, 54EC, 54G, 54H. Then income from other sources. So, income from other sources, incomes generated other than apart from the 4 heads of income from salary, income from house property, income from capital gain, or income from business or profession. Apart from these 4 heads, any other incomes is comes under this category. For example, winning from lotteries, dividend from cooperative societies, crossword puzzles, and other games, gifts. Okay. Then all the 5 heads you have to calculate, add all the 5 heads of income, you can arrive gross total income less deduction under section 80C to 80U taxable income. Now, this tax rate is there. There are 2 types of tax rate is there. Old slab rate and new slab rate is there. Old slab rate is suitable for aged people, those who are working more than 20 years. They can claim the other benefits. They may have more savings. They can enjoy the privileges. Then the new tax system, it's exempted up to 5 lakhs. This is applicable only for newly joined employees. They can claim the tax benefit. Then there are important exemptions is there. Then there are important deductions also is there. Deductions under section 80C you can claim maximum 1,50,000 rupees. Then certain important useful tips. Yes, income from capital gain, sale consideration, less selling expenses. The net sale consideration you can arrive, less cost of acquisition and cost of improvement. Then you can get capital gain, whether it may be short term or long term. Less exemption under section 54, 54B, 54D, 54EC, 54G and 54H. Then finally you can arrive taxable income from capital gain. Then income from other sources. Apart from these 4 heads, any other income is there, it comes under this category. For example, winning from lotteries, dividend from cooperative societies, crossword puzzles, then and other games, gifts also. Then you can calculate all the heads of income. Income from salary, income from house property, income from business or profession, income from capital gain, income from other sources, all put together, it is called as gross total income. Less deduction under section 80C to 80U. Then you can arrive taxable income. Then there are 2 types of slab rate is there, new slab rate and old slab rate. Okay. Now it is you can choose option to assessee, you can choose any one of the slab rate. Okay. For the age-old people, they can choose that old slab rate. Okay. It's exempted up to 2.5 lakhs. The new slab rate exemption up to 5 lakhs is only for newly joined employees. They can choose this new slab rate because they cannot claim the more exemption, but the maximum limit up to 5 lakhs they can enjoy the benefit. But under old slab rate 2.5 lakhs. Okay, up to 2.5 lakhs is exempted. If it is, they can enjoy the other privileges, savings and other benefits. Now, we are going to discuss about some useful tips about the taxpayers. Okay, middle class taxpayers enjoy some benefits. Standard deduction of salaried person raised from 40,000 to 50,000 rupees. Individuals having taxable income up to 5 lakhs to get a rebate of tax under section 87A, 12,500 rebate maximum they can claim. TDS threshold limit, interest on bank and post office deposits raised from 10,000 to 40,000 rupees. Under section 54, capital gain exemption now available on purchase of 2 house properties once in a lifetime. This opportunity is available once in a lifetime. Then I will give you an example for the tax savings. Okay. The employee can get more revenues up to 6,60,000 rupees you can earn without paying tax. Okay. Basic salary 30,000 into 12, 3,60,000, taxable portion of HRA 96,000, special allowance 1,92,000, total salary it comes total salary 6,48,000, income from other sources 12,000, gross total income 6,60,000. You can eligible to claim deduction under section 80C, maximum limit 1,50,000. Then under section 80 TTA you can claim 10,000 rupees. Then taxable income comes to 5 lakhs. Okay. If the income is 5 lakhs, up to 5 lakhs they can claim rebate under section 87A, 12,500. The tax liability comes to 12,500, they can claim the entire tax liability as a exemption. Okay. Then HRA 96,000, then deduction 1,50,000, 780 savings is there, but you can claim only maximum 1,50,000 rupees. Deduction under section 80 TTA, interest on saving bank deposits, okay, they can claim for below 60 years of age limit, they can claim maximum 10,000 rupees. Then, in the case of failure to file ITR, income tax return, prosecution may be initiated under section 276 CC of Income Tax Act, provided the taxpayers by assessing rupees 10,000 rupees or more. Now we will come to conclusion. A good tax system should be able to balance the need for arising maximum possible resources and need to minimize the tax burden on the taxpayers. The penalty for providing correct details of your income or concealing income tax will be 100% to 300% of tax, evading as per the section 271C of Income Tax Act 1961. If they fail to file a return or if you are giving false data, then you will be penalized. You have to pay a penalty from 100% to maximum 300%. Be a good citizen, better to pay tax on time and enjoy all the privileges provided by the income tax authorities. Thank you.